Hey everybody, Marty Missouri. Good morning, November 15th, 2018. Thought I would pop in briefly for you this morning and update the chart we were tracking here, 2, 3 weeks ago amid the notable correction for October that looks to be spilling now into November as we're halfway through the month. I haven't been as able to be as active on the blog. For those of you who look for sometimes multiple daily updates during volatile periods, I apologize, just not in a position this week to be able to do that, but am paying very close attention to what's going on in the world, and of course, always feel compelled to help you put it in perspective or at least understand what I'm thinking or what we're thinking about everything here at Private Wealth Advisors. So without any further ado, the chart in front of you, those of you who have been consistently with me here on the blog, it'll look familiar, although it's updated. We started this video series right around October 16th or 17th, after the market looked like it might be forming a bottom after a noticeable correction in the month of October. I said in here that the look of the on-balance volume indicator was not inspiring me, and I said we should expect a retest and perhaps maybe a breaching of that low. Well, that's exactly what happened, and we came in here and bounced off of the low on the 29th of October and actually bounced with a pretty positive looking on balance volume here. And then we peaked just this last week on November 8th and have fallen back precipitously here. Now, headlines there had suggested that Apple earnings, or couldn't have been the earnings because they were very good. And a couple things, and I actually wrote a couple pieces on it, was during the conference call, which I listened to, the decision that Apple made to no longer report on unit sales of iPhones was addressed. And as I said in the blog, that clearly had to be viewed as a negative. I'm not of the mind that believes that Apple is ready to go falling into the abyss despite the pretty notable sell-off here of late. I think it's an evolving company in an evolving world and an evolving industry. I think the next few years are going to be very interesting as 5G hits the world stage, and that's a big deal that I've written about a bit herein. That will ultimately lead to huge iPhone sales at some point in the future. But there's just a whole new round of technological advancement that will hit the world over the next few years, and it's beginning to as I speak. And it lends itself to huge gains in productivity, efficiency, speed, all those kinds of things. So that's a story we're going to be talking about a lot in the years to come. And it's a good story for companies like Apple, on top of the fact that they're just executing excellently. And when you look at them on a simple price to earnings valuation basis, they are anything but expensive at $188 a share. So we don't think Apple is the end of the world. Of course, it's a big company, the biggest company, so it's going to be a strain on the indexes when it suffers its pain. Also, in here, we had some unfortunate rhetoric coming from one White House official who has effectively been muzzled as of this week, and that's trade advisor Peter Navarro. He has an interesting and unfortunate perspective on how to approach our issues with China, and he's had a major influence on the administration up to this point, and he kind of freelanced a bit in here and made some comments about Wall Street and their influence on the process and so on and so forth. Market accepted those like a really bad toothache, along with other things, of course, and we won't be hearing from Mr. Navarro anytime soon, from what I understand. So now negotiations will ensue. Probably should be optimistic, and I think it's because the administration is getting the message that while all of us should understand and agree that there are issues such as intellectual property theft and so on, isolating us from the Chinese market, raising big tariffs on consumer goods and that sort of thing. Not good for the US consumer, not good for the Chinese consumer, not good for US producers. I think that message is being sent quite resoundingly. I think the administration is listening, and my best guess is that they will pivot to an entirely different strategy in dealing with China and intellectual property theft and any other legitimate issues that we should be concerned about. The other thing weighing on the market this morning are ongoing Brexit negotiations, which have kind of fallen out of bed here overnight with a couple of key players resigning their positions. Brexit, as you may recall, mid-2016 was a huge concern for the market that really didn't turn out to be anything too ugly, simply because it's a long, long process for a country to divorce itself from the European Union. It is a hugely risky, potentially very ugly endeavor, particularly for the UK. And I think the world is beginning to understand that as well. And it's weighing certainly on the markets, certainly on the currency markets. And that's really what I kind of keep my eye on. If the UK and the EU negotiations just go completely south, certainly the pound versus the dollar is going to tank. And a strong dollar, a real strong dollar, because of, say, Brexit falling out of bed, would be problematic. Quite a bit of time left for negotiations, and then even after something's agreed, the transition period is multiple months into the future. But right now, the market is skittish. It is nervous about what's going on. It's on several fronts in the world. There's more that I can talk about. Italy's got huge issues with its new populist government that wants to spend way beyond the country's means. And so none of it at this moment points to a morphing into a great global recession. These are things we need to keep our eyes on, and things that certainly lend to a greater amount of volatility. I will still maintain that the best thing that can happen right now for the markets is the beginning of serious, legitimate negotiations with China, where both sides want to bring this to solution sooner than later. Okay, so back to the chart. Here we had some encouraging on-balance volume. We had a nice rally there. We saw it fall out of bed. Right now, as I speak, we're testing that first bottom right here that actually that the market actually failed here. Right now, this is not a good look, not at all. This says that there was a lot of passion behind this selling. That would tell me that odds would favor a test of this level here. So I just want to prepare you for potentially more downside volatility, and we'll see. And of course, we could even breach this level here. Another thing that's been talked about is that October was the worst month since 2011. Sometimes it's instructive to actually go back and say, okay, let's take a look at that 2011 period, and let's see how the market handled that. And what ultimately happened? Did it morph into a bear market, or did we ultimately bounce out of it? So here's what everybody's talking about. In July of 2011, this was almost a 20% correction, believe it or not, but when it finally worked itself out. So this was bigger than the one we're experiencing right now. You see the huge decline in on-balance volume. You see the sketchy look here. Looks decent here, kind of came back. This looks a lot like what I just showed you. Came down just straight, very precipitously, looked like we were trying to find a bottom and so forth. Little encouraging here, beginning to fall back. So the first maybe bottom was on August 9th. Here we are out here a month later. Look like we're about to test that again. Let's fast forward a month. So as you can see in October, in fact on October 4th, sure enough, this bottom was tested on an intraday basis, and the market bounced off of that. Notice what's happening here though. After on-balance volume rolled over once again, the market rolled over, but we started getting higher lows in the on-balance volume. This suggests that folks were buying these rallies more so than they were selling the dips, as volume was heavier on the up days. And then if we fast forward to the end of the year 2011, you can see the market began to recover, with a lot of volatility along the way, but definitely began to recover. And this turned out to be a bottom that stuck. And then when we fast forward to today, you can see that this 2011 is a very distant memory. But again, this was almost 20%, 19% correction. Took 2 long, tough months of patience to work its way out before the market finally tested that a few times and then broke above it. 2 back-to-back 10% corrections here in 2015 and 16, but we continue to move higher, and here's where we find ourselves today, a month away from that first bottom here. So if it's a repeat of 2011, we've got another month of this mess to kind of work our way through. Of course, we are getting to year end. We're getting to the two of the best months of the year historically. Midterm election years tend to be better than most from this point forward. I think there's still a good chance we end the year quite strongly. But it just appears, at least as I look here today, we've got potentially some more downside volatility ahead of us before we actually bounce in a serious way. So in closing, I want to draw just one more parallel to 2011. And we'll just call this more of a fundamental look. We've looked at technicals with these charts, and I can get really into the weeds and show you other indicators that might be suggesting bottoms and tops or bigger drops and so forth. But really, at the end of the day, I'm really most interested in the macro backdrop or general conditions. Here is that big decline in 2011. This +8 here was the back test, what we call our PWA index. Today it's 84 different data points, mostly US, although we do mix in what we think are important foreign and global indicators to give us a feel for the state of the US and the global economy. It's below zero. The way we score it suggests an increased risk or a greater risk of recession going forward versus continued expansion. Above zero suggests that odds favor continued expansion. So when we back tested it right in here during this correction, you can see that we were getting pretty close to zero, but it was still net positive, and we did not roll over into a great recession and a great bear market as we did back here when the real estate bubble burst. And this was all-time highs with a -33 on the index. And here we are back when the tech bubble burst, and this was an area of all-time highs in stocks while the PWA index was rolling over. This last weekend, it scored a +36, which is lower than it was at the beginning of the year with a +81, but still quite a ways from zero. So those of you whose portfolios we manage, this gives you a feel for why we're not at all panicky here and are not in any big way moving to a defensive posture in the way that we would if this was a -36 on this dip, as it was here during this dip. Even though the market bounced back and we would not have looked very smart as we were getting defensive here, sure enough, it was a good thing to do. Same thing here on this dip, we were a -10. Today we'd be getting defensive with a -10, and the market would have left us behind for about 9 months before it really rolled over. So I suspect that when we ultimately get there, which we ultimately will, and begin migrating to a notably more defensive posture, it could look as though it was an ill-advised move for a while, because we don't want to do market timing here. What we do is we want to invest according to what general conditions dictate. And today, folks, general conditions do not dictate that we start getting defensive, despite the fact that we're experiencing some pretty uncomfortable volatility. Now, this can change. This can morph into a negative scenario, and we could get defensive. We're just not there yet. We'll keep you posted. Thank you, as always, for watching and listening, and I will be back at my next opportunity. Take care. Bye-bye.